Hi everyone. Today we'll break down our portfolio analysis by Orlando, Dafa, Rafael, Carl, and Delon. Next, please. So we have three stocks in total. I'll start off with Bank Mandiri. So we'll be discussing the company overview, financial ratios, risk, and economic analysis. Next, please. So the company overview. So Bank Mandiri with the ticker name BMRI. It works in banking sector. In fact, one of the largest banks in Indonesia and also largest by total assets on EDX. So the main services of Mandiri is corporate, retail, SME, and digital banking and plays a strong role in Indonesia's economy. Next. So I'll be discussing the financial performance. So the ROE shows a stable improvement from 2021 to 2025, as you guys can see from the table. It increased from year to year. Moving on to net profit margin increase to 40% from 2021, which is 29%, to 2025 to up to 40%. And then the current ratio is also rising, which leads to better liquidity. 2021, 1.2, and 2025, 1.46. And lastly is debt to equity decreasing, which means stronger financial stability. 2021 6.7 to 2025 5.4. Next, market risk and return. So our main competitor is BRI, BCA, and BNI. Banking demand remains stable long term, and the stock price trend consistent growth from 2021 to 2025. Average return 1.7%, moderate risk, standard deviation 4.5% to 6.7%. Next. So in conclusion is so we have stable demand for growing economy. It also supported by GDP growth and population. It also being backed by government or BUMN, which means lower risk. It produced consistent returns with moderate volatility, and lastly suitable for long-term and stable investment. Plus, the floor is to Dylan.
Okay, so now I'm gonna discuss about the PT Indofood or ENDF. I'm gonna discuss about the company overview first. So Indofood is one of the largest food companies in Indonesia and the leader in instant noodles like Indomie. Because food is a basic necessity, its demand is stable. And then next, please. So next, I'm gonna explain about the financial performance. So, Indofood shows stable revenue and profit due to consistent demand. Its ROE is increasing, profit margin is strong, liquidity is improving, and debt is decreasing. This indicates the company is financially healthy and well managed. Next. So next is the market risk and return. So Indofood operates in a competitive FMCG industry, but demand remains stable. It provides steady returns with lower volatility compared to other sectors, which beta below 1. Indofood is less sensitive to market change, making it a defensive and lower risk investment. So as you can see from the data. Next. And the last one is the investment conclusion. So the conclusion is suitable for long-term investors, provides stable return with lower risk, good diversification asset in portfolio, strong brand like Indomie, ensures continuous demand. And the last one is recommend as a defensive stock in Indonesian market. Next, I'm gonna give to Carl.
Now I'll explain about United Tractors. United Tractors operates in Indonesia's infrastructure, mining, and heavy equipment sectors. It plays an important role in supporting commodity production and national development. The company is also a subsidiary of Astra International, which strengthens its financial and operational ability. Now, next slide, please. Looking at its financial performance, revenue and profit are generally stable. As you can see, uh, is very generally stable, supported by demand from mining and construction activities. Its return on equity shows that like a consistent, meaning the company is able to generate stable returns for shareholders, and also the net profit margins they remain strong at around 18 to 23%, indicating good profitability. Current ratio is about 1.4, showing a healthy liquidity, and the debt to equity ratio is low, which means the company does not rely on heavily on debt. So, next slide, please. In terms of risk and return, United Tractors offers an average return of 1.7% per month, which relatively high is beta is around 0.85, meaning its market risk slightly below an overall market. However, its standard deviation is about 88.43%, making it the most volatile stock among the three. It shows that while market risk is moderate, the company has higher firm specific risk. Next slide, please. In conclusion, United Tractors offer higher return potential, but with higher volatility, it is suitable for long-term investors who are confident in Indonesia's infrastructures and economic growth. Now I'm going to give the talk to Rafa.
Yes. So in the second step, we calculate the return, beta, and standard deviation, and then we construct the portfolio. So the first one being calculating the return. So the return from 5 years, the arithmetic mean returns, the UT has the highest one, which is 1.66. Mandiri followed with 1.51 and Indofood with 0.65. From this, we can see that United Tractors provide the highest expected returns, while Indofood offers the lowest growth potentials. However, return alone does not tell the full story. Then we must compare it with risk. So in the beta, which is a market risk, we analyze the measure systematic risk or sensitivity to the market. Mandiri has a beta of 1.29, UT has a beta of 0.91, and Indofood have very low beta of 0.16. This allows us that Mandiri is an aggressive stock, Indofood is defensive, like we discussed, and UT is close to the market average risk. Moving on to the overall volatility. So UT has 8.43, which is most volatile. Mandiri is 7.64, and Indofood is the last, which is most stable. Some interesting insights. UT has actually the highest volatility, which means UT has a moderate market risk and high unsystematic company specific risk.
Okay, so now we're gonna expand the return, fairness, and standard deviation of portfolio. So as you can see, I've constructed a portfolio consisting of Mandiri, Indofood, UNTR, and IHSG before, of course, I applying for the solver. And based on this, I've managed to get return 1.20%. The variance is 0.19%, and the standard deviation is 4%. Although some of these stocks have a high volatility given the number, including IHSG, but however, IHSG helped to stabilize the portfolio. It represents the broader market and it's less volatile compared to the individual stocks. This demonstrates the benefit of diversification, where combining assets that are not perfectly correlated reduces the total risk. And this is without the IHSG. As you can see, the expected return is 1.31, the variance is 3.40, and the expected to earn is 1.31. the standard deviation is approximately 18%, which represents the total risk. So this means that although the diversification across the three stocks helps reduce firm-specific risks, the overall volatility remains relatively high because they do not have the IHSG. It only consists of individual stocks and does not include the broader market index, as I explained before. And now, after using the solver, you can see the portfolio generates an expected return of 1.2% with a variance of 0.13% and a standard deviation of 4%. Compared to the initial allocation, this optimized portfolio provides a better balance between return and risk. Although the expected return is, slightly lower, the reduction in overall risk improved the portfolio's efficiency. The inclusion is that IHSG is important because it represents the overall Indonesian market and has lower volatility than individual stocks. Allocating a larger portion to IHSG helps stabilize the portfolio while maintaining positive expected returns. And now this is the solver without IHSG. As you can see, the solver allocated 100% weight to Indofood with zero allocation to Mandiri and UNTR after the solver. This means that although the return is lower compared to the initial allocator, the Sharpe ratio improved because Indofood provide the best risk-adjusted among these three stocks. This result indicates that based on risk-return efficiency, holding only Indofood is the most optimal strategy when the portfolio does not include IHSG. And the last one would be explained by Rafa.
So I think this is the most important one, which is the reflection. So from this project, we have learned that higher return usually comes with a higher risk. Beta and standard deviation measures different types of risk. Diversification is mathematically powerful. And lastly, portfolio construction is about balancing trade-offs, not maximizing one variable. In conclusion, investing is not about chasing the highest return, but about achieving the best risk-adjusted performance. Thank you.
Thank you all. I hope you understand a bit of finance after listening us, and stay tuned because we're gonna have the next one. Thank you.
Thank you.